Buenas noches con todos y bienvenidos a la primera sesión de recuperación. Un momento de confirmar que se ha terminado de cargar en Blackboard. Finalmente ya 5 minutos de cargando. Ok, un segundo, vamos a ver esto adecuadamente. Push my cash flow. Sorry, tengo una. Muchas gracias Elvis López es nuestro modelador. Vamos a empezar de una vez. Por favor, compartir pantalla. No estoy encontrando el estéreo. Okay, so finally. So last time we were chatting about how to calculate the free cash flow, and we actually went through the whole process of finding out information that we needed on our 10K, right, for Ferry Corp as part of our total calculation that we were performing, right? So we are just to recap, right, on that. We're saying, hey, if we're going to do in a forecasting, we're probably going to assume marginal tax rate, right? Considering the fact that we don't know enough about how taxes are going to behave or how it's going to be the tax strategy that the company is going to follow, right? So we assume that this is going to be a more sensitive and reasonable approach, similar to any companies that you may find out in this arena, right? In this information that we are talking about. Okay, but if we were going to chat about the historical numbers, right? If you're already analyzing historical data from the 10K, as we are doing right now, you have two alternatives, right? Either try to figure out the effective tax rate, which is not difficult, given that you have the income taxes and the earnings before taxes, or add, in addition to that, estimate this, right, using the actual tax number, right? But in that case, if the case, you should adjust for the interest tax shields in order to arrive to the correct value of free cash flow, right? Just to reiterate that free cash flow is going to be the cash flow that you're going to consider for the whole company, right? So that means all the stakeholders that should have a claim over the cash flows from the assets. So that's going to be the debt holders and the shareholder as part of the calculation. Get that back up. Just a minute. Okay. So if we were doing this analysis, we actually went over each one of these elements. And today's class is going to verse on the discount rate, right? That we were chatting last time. We actually mentioned that there are two ways to calculate the present value or the enterprise value of a company, right? The present value of the free cash flows or the enterprise value of a company. There's the possibility to use the weighted average cost of capital approach, right? Or there's another alternative to use the adjusted present value approach. So let me just quickly jump on that one. Right, we're chatting about here on discounted. I actually have it here on discounted cash flows, right? Let me just check that that's being presented correctly. Yes. We were chatting last time on discounted cash flows, right? And we said, hey, there are several alternatives to come up with the valuation that we are looking for, right? We want to come up with the enterprise value, which is one of the key elements to arrive to the equity value that you'd like to find out. We can use free cash flows and apply as discount rate the weighted average cost of capital, right? But relative to that, we can go with the free cash flows and try to apply It's called the adjusted present value methodology. The adjusted present value methodology implies that you do not model the interest tax shields in the weighted average cost of capital. You do not incorporate that benefit in the weighted average cost of capital in the discount rate, but instead of that, you assume a company that does not have any leverage, right? So you're going to discount the free cash flow at the required return on assets, and you're going to model the interest tax shield. You're going to calculate the interest tax shield. You're going to forecast the interest tax shields in the coming years and discount that at the required return on interest rates. Sorry, on interest tax shields. That was a wrong expression. So you're going to discount that the required return on interest tax shields, right? And we're going to define what's going to be that required return on interest tax shields in a bit, right? As long as we go through this session, hopefully we're going to arrive to the adjusted present value calculation, right? That's what we're going to focus on that. First of all, let me dive on the cost of capital. Oh, sorry, here says economist. I misspelled that. But I wanted to highlight what is the WACC, right? And we're going to go over each one of the elements that we have over here and do the practitioner side, right? Where do I get these numbers? Where we are going to be capable of getting all this information that we're talking about, right? And we're going to try to apply that to Ferrycorp, right? We're going to try to figure out, okay, what's this company doing, right? And where are we going to be able to get all this information that's appearing over here, right? That's part of the whole ordeal that we're going to be working on. Typically, if you go to the weighted average cost of capital, you know that takes into account what's going to be the return that the shareholders are expecting, right? That the required return on equity. That's the amount that costs us to us all that equity that we have. And you also have to consider what's going to be the required return on debt, right? That's the amount that we should be expecting, right? Coming out from our debt holders. What's the interest rate that they will charge us right now, right? If we want to get additional debt, right? Or we want to get the amount of debt that we already have on our balance sheet. Logically, these things are weighted, right, by the proportion of equity over the total assets of the company, right, over total debt plus equity of the company, and similarly for the debt. The key element here is to think about market values, right? And that's where the problem arises, because it's very difficult to come up with the market value of debt or the market value of equity, right? If the company is not public, or if the company has no issued any debt into the market. So if the company has no bonds, right, the market value of debt that you are going to try to estimate is going to be basically the historical value that the company has balance sheet, right? So if we want to go to our point that we have been analyzing so far, right? Ferrycorp, right? What I mean is, okay, you do have some information on Ferrycorp, right? And you can try to estimate their financial obligations. And let me just tweak here the balance sheet, right, a bit. What you are going to say, hey, yes, there's some information on the liability side, right? We're going to have all the financial obligations right here and the estimation of the financial obligations right here, right? So you have the short-term portion of the financial obligation and you have the long-term portion of those financial obligations. Everything is on notes 12 and 13. I wanted to draw your attention to those notes, right? Because obviously you are going to be capable of getting a sense of what is normally charged to this company, right, by your debt holders. Let me just squeeze that up, rotate it right again, right? So we're going to be seeing that in this particular case, right, this company does have some loans from different financial institutions. We're going to see here what is the average interest rate that they are charging you, right? They usually give you a range. They do not provide you with the actual number, right? In 2019 and 2013, specifying what is the short-term portion and the long-term portion of these elements, right? That's the typical way we see this. And in addition to that, let's close that up a little bit farther, right? There's scroll down. So it's not helping me here. We're going to be seeing A, B, and C right around here, right? Here are the bonds. That's what I was looking for. There are some bonds that are already on the market, right? There has bond that has been issued outside Peru, right, following the rule 144A. So the 144A, it's a way to issue bonds into the United States security market, right, by companies that do not reside in the US. So companies such as the ones in Peru can issue corporate bonds out there, right? And you can try to come up with, or actually figure it out, what is the yield of those bonds, right? To arrive to a better estimation of how much this company has. What's the problem for us? Those bonds were only present, they were only valid, they existed only in 2018, right? By the end of 2019, there were the rate of those bonds. What's the good thing about these bonds? These bonds, obviously, if they are in a developed economy, as we are analyzing here, right, it actually is going to allow us to figure out what is the market value of those, right? Bonds, as you normally know, they're actively traded, especially in developed economies, right? And you can figure it out what is the market value of the bond, price of the bond, right? And if you have the price of the bond, you also know that you have the yield to maturity of the bond. You have the yield on the bond. I do not mean the interest rate. I do not mean the coupon rate on the bond, right? I mean what is going to be the yield, right, that they're going to be having. Here, this is the coupon rate that shows us here the nominal rate of 4.875 compared to an effective rate of 4.934, right? They do that in order to make it more comparable. The accountants do that to make it more comparable to the rates that we are seeing in these notes, in these pares, right? And the information that we have on the loans from the banks, right? Okay, so let me clarify that for a bit for everybody, right? So when you analyze bonds, right, when you have been evaluating bonds outside Peru, you probably have realized that most of them manage this idea of simple interest rate, right? Just have interest rate multiplied times the number of days divided by 365, and you can figure it out the rate. And we talk about it, right? And I already mentioned this when we're analyzing debt. And what I said is that here in Peru, we are one of the few countries that use effective rate as part of our normal lingo, as part of the usual ways loans are treated, right? And for that reason, when the accountants try to present the information here for Ferrycorp, they had to convert it to effective rate. Okay, but coming back to what I wanted to highlight, right? We were saying this here, we're saying that we were looking for the market value, right, of the debt. And here we're going to have a problem. And you're going to observe that problem many, many times, right? Because the notes, right, are not going to be market value. The loans from the banks are not going to be market value, right? You're going to just realize, okay, this is the amount that we owe to the bank, and we're going to assume, right, this book value, right, of the loans to the bank is going to be a good estimate of the market value. Right? So once again, when we are going to be talking about the debt market value, it is highly likely that we're going to end up using the book value in most companies, because as you're going to observe, in many developing economies such as ours, companies do not issue bonds, right, that are actively traded in the market. Right? This was a good example that they had issued that bond, right, in the US, but right now they no longer have it. And what about the companies that issue bonds locally, right here in Peru? The problem with that is that our secondary market funds is highly illiquid, right? If you have heard that the stock market, right, the Lima Stock Exchange is very illiquid with low negotiating values, right, with low amount of negotiation of stocks, right, the bond market is worse than that. The problem with the bonds that are traded locally is that, well, they are not traded locally, and the prices that you observe usually are prices that been uh, have been market that have been negotiated several months ago and even years, right? I was actually looking at a yield to maturity curve, right, that is being used for double A bonds, right? And the problem with that is that they were using information for 7 years or 10 years, right? That was actually from 3 or 4 years ago, right? So the problem is that if the bonds are not traded, you cannot figure out what is the current price, the actual price of the bond. And if you don't know the actual price of the bonds, you're going to be using the historical price, right? The price that was traded the last time. And the last time that bond was traded was 2 years ago, right? And that's not market data. So in those cases I mentioned, it's actually better to go with book value, right, as an estimate of what it is the market value that you have for your debt. Okay. What happens with your equity value, right? You actually like to come up with a market value of that. And that's simple and that's possible if the company is public, right? If the company has stocks that are being traded in a stock exchange, right? And it will allow you to figure out what's going to be the market value of the company. Similarly, right, if the stock has not been trading for a while, the price will not correctly reflect the market value of the company, right? And in those situations, what will happen, right, in these cases? Well, obviously, you can actually use the book value, like that's a possibility, right? Yes, some people do use that, and we have seen several variations coming up with that. But what I'll suggest, obviously, is go with the ratio, right? Try to arrive to the debt equity ratio that is being used by comparable companies. We would like to come up with an estimate that, okay, at the end of the day, no matter if we deviate a little bit, right, in some years, we should be able to arrive to what is the industry standard of leverage, right? It is possible that we can increase our leverage for some period of time, or we can decrease it, but eventually we should arrive on average to what's going to be that ratio of debt to equity, right? And logically, you would like comparables in our industry, right, and in our country. And that's difficult, obviously, right? That's the difficulty that you're going to arrive to come out. And that's why a lot of people will go with this, the book value numbers that I mentioned here. Right? So imagine if we are talking about here, right? Already talk about it's going to be. Let me just switch this back to the left, right? We are just saying, hey, when we are going to be seeing the balance sheet, right? You are going to be imagining to come up with, right, to the financial obligations that we have, and remember these liabilities for leasing, right? That we have been talking about regarding NIF 16 as debt, right? They're going to have an interest, implicit interest, and logically you're going to be trying to come up with what's going to be the value of the total network, right? Of the total equity, which obviously includes the stock that has been issued, right? The additional stock, the legal reserve, and the accumulated results, right, from prior years as we've seen, right? Um, as you may know, there's this other line called treasury stocks, treasury shares, right, which is basically shares that have been reported by the company and they are keeping them on the books, but they have not canceled them, right? So those shares are on the company's balance sheet, right? They don't have control over that, and they are no longer being traded in the market at this point, right? Okay. So far, I have just touched base on these key elements. Right? I already mentioned the required return on debt, right? Basically, I said that you should try to come up with the yield for this particular company if the company has a bond that is traded in the market, right? If you do not have that, right? Let's imagine for a minute that you are working for the company, that you are on the sell side of the company, you are doing the valuation of the company. A quick way to come up with that number, right, is to do a market read on your debt holders, right? So you go to the different debt holders that you have. As we can realize here, there are several banks that are already interested in our company, in Ferry Corp, and you go and ask them, hey, how much can I refinance, or how much will be the interest rate that I should pay right now for X amount of money? If we went to have all the loans refinance with you, right? What will be the interest rate that we should be facing? And that should be an estimate of your required return on debt, right? That's the key element that we would like to have. But logically, and that happens more often, right? You are not going to be capable of. You're not on the sell side, yeah, right? You're not going to be capable of getting that insight. Let's quickly scroll the back. You're not be capable of getting that insight that I'm mentioning, right? And hence, what you are going to try to come up with is an estimation of the financial obligations out of this information that appears here. Yes, is the font. Right? So basically, on the interest rate numbers, right? On the interest rate numbers that are appearing here for effective annual rate, right? You would like to come up with what's the most reasonable interest rate that I will be paying, right? Logically, the first thing some of you are gonna say is, should I be focusing on the short term or only on the long term part of the debt, right? So our aim when we are performing evaluation is imagining a period of time that's going to help the company stabilize, right? So usually you should be aiming at a time frame of 5 to 10 years as part of your typical estimation. So these, unfortunately, these short-term loans, right, that we are seeing here that are going to be due in 21, right, in April and in April and here in June 2022 are going to be a low interest rate that we should not be facing or considering in our analysis. We should be focusing more on the long-term loans that we are seeing here, right? And trying to come up with, okay, what is the maturity that we should be expecting that occur in these loans, right? And in that sense, figure out what's going to be the interest rate that we should consider for the company, right? So the loans that are coming from the bank's loans, right, usually have a period between 3 to 5 years, right? Unless it's a project finance where you can get a longer period of time, this interest rate, or the weighted average of this interest rate, will provide a more sensible estimate of what should be this required return that we are looking for, right? Okay, any questions so far on what I have been saying in this instance? Okay, we only have 11, but let me quickly jump into, and you do remember that I mentioned this when we were talking about financial obligations, right? We're talking about where to get some information regarding my interest rate. I already talked about this. I'm quickly just jump on that. So here, the Superintendencia de Mercado de Valores has a very nice report, right? It will allow you to figure out what should be the interest rate that your company should be facing, in addition to what I just said, right? So let me go to 2019 for a minute, because 2020 has a lot of bias on the estimations, right? But if we want to feel, and there are very few issuance into the market. If we want to imagine for a minute that, okay, I do not believe that the information that we have from loans is a sensible number to estimate the required term debt. If I don't think that's the best way to do it, maybe we can reach out and try to figure out how much we can obtain thinking about comparable firms, right? So here the Superintendencia de Mercado de Valores has called information on the primary public offering, right? From bonds, and I'm going to open that very quickly. That's going to show here an Excel file that is being downloaded and it's going to be open in a bit. Right? And that Excel file that I'm uploading is going to show me information on several companies in several industries that have issued bonds right into the market, right, on in the year 2019, right? So let's imagine for a minute, right? Let me just think about our friends here. Let me just confirm that. That's a very good year that we're going to see. So if you have not heard about this, let me just increase it for a little bit, right? Our friend Agrícola y Ganadera Chavín de Huántar, right? It's an agriculture and cattle company, right? And they have issued corporate bonds, right? You may have heard of because it was the first company that started Mercado Alternativo de Valores, right? The Superintendencia de Mercado de Valores created an alternative to the general way companies issue bonds into the market or issue short-term instruments into the market, right? And the first company who started that was Agrícola Ganadera Chavín de Huántar. It has a special situation, right? There are right now like 12, 15 companies that have started that issue, right? Eurocapital Servicios Financieros among them, right? That issue short-term instruments. Agrícola y Ganadera Chavín de Huántar is also one of the few who have issued corporate bonds. Imagine for a minute that I believe that my company is also in the cattle business, and I imagine that I can obtain a rating of A. By the way, you realize that the companies that are on the Mercado Alternativo de Valores only have one rating, right? They not require two ratings as the normal ones. And the reason for that is that you want to make them save money, right? You want to help them issue by getting only one rating. So imagine that you're a company once again and you have a rating of A, right? And we are close here. This was issued, by the way, August 2019. And you imagine, okay, if I'm similar to this company, maybe in terms of rating, obviously, maybe if I issue a bond, right, for 5 years, I'm going to be capable of getting a 9% interest rate, right? And this is in dollars, right? That I will be getting for 1.7 million that they have issued, right? And for them, obviously, this is an improvement, right? Remember, these are medium-sized companies, right? Medium to big-sized companies, not corporate ones that are getting this structure. Or imagine if we, let me just go to another one that should be here that we can consider here. Imagine that you in the energy sector, right? Let's imagine you are Statkraft, right? Statkraft is an energy company here in Peru that has also headquarters right in Norway as part of that. And imagine that you believe that you want to get into the distribution business and not only in the production of energy, and you realize, okay, there are corporate bonds that Luz del Sur issued right in October, 2019. If I'm in that same structure of them, if I believe that we are AAA, Statkraft is AAA, right? A AAA company issue 168 million soles, right, in October 2019 for 15 years, and the interest rate was only 5.22, right, in soles. That's what AAA companies are capable of getting. So if you imagine that your company is AAA, right, and they have been a recent issuance of bonds, right, you may use this information to arrive to the market value of the required return on debt that you should be considered into your weighted average cost of capital, right? Okay. Without further ado, right, we have already covered the more direct elements into the weighted average cost of capital, right? We have talked about should we do an adjustment? So, Nicole, adelante.
Profe, no me queda claro si es que lo que acabas de mostrar de las tasas sería que, o sea, tomo una empresa comparable y tomo la tasa de interés que tiene para sacar el WACC, o es que mi empresa debería aparecer en la lista y yo ahí tomo su tasa de interés.
No, tu empresa va a aparecer en la lista a menos que hagas una emisión de bonos, ¿sí? Entonces, ¿qué es lo que va a pasar? Si tu empresa es una empresa AAA y Luz del Sur acaba de emitir a ese nivel de AAA, déjame buscar Luz del Sur nuevamente para moverla, y Luz del Sur emitido con ese nivel de AAA, debe ser posible que tú tengas un financiamiento similar y esa tasa de 5,22 que estaba mencionando resulta siendo razonable para tu empresa AAA. ¿Sí? Si estás en un sector similar, ¿cuál es la ventaja de Luz del Sur? Evidentemente, se dan cuenta ustedes de que es una empresa de servicios públicos, entonces sus clientes va a ser muy difícil que dejen de pagarle, ¿no? Porque efectivamente nadie quiere que le corten energía ni la luz. Entonces va a resultar que este pago a 5 a 15 años resulta siendo menos riesgoso esta deuda que está tomando de 168 millones de soles. Pero aún así, si fuéramos una empresa que básicamente tiene un desarrollo o un riesgo similar, que está siendo clasificado como AAA, yo más debería considerar este 522 como la que debería tener mi empresa, puede acceder a mi empresa. Ahora, acá tengo otra pregunta de Paola Bejarano. Should make an adjustment? It's very difficult to make an adjustment, right? If we do not if we do not believe that the term is going to be the best one, right? Okay, 15 years is too long, right? Then what you need to figure out is, okay, is there any other AAA, right? And that it's gonna be issuing bonds. So let's imagine here, we have here one for 3 years, Santander. Okay, should it be possible that I use this to interpolate between 3 and 15 years? For a 10-year average, maybe, right? Maybe. It's not gonna be that straightforward, right? But what I would argue is you should always stick to the rate, to la nota de clasificación, to the classification value they have been given, right? You should not move from AAA to AA trying to do an interpolation between them, right? Because they're actually quite different in the way they behave and how the curve is depicted, how the curve is graphed. For each one of the different terms, they're going to have a different value, right, in order to arrive to this calculation. So you should try to come out with this 522 that we are just mentioning here, right? Yeah, and actually, we are thinking about long term, right? These 15 years is nailing it perfectly about how long we should be focusing. Usually, you will find 5-year numbers, right, when we are going to be calculating this. Sí, Paula.
Profesor, y si encontramos, por ejemplo, hay dos empresas que sean comparables y una tiene un plazo, no sé, 3 años y otra de 10 años y ambas tienen, digamos, son parecidas a mi empresa, ¿cuál debería tomar?
It's a judgment call. Es una decisión, o sea, si ambas son parecidas, y un segundo, se va a rayar. Si ambas son parecidas, lo que yo sugeriría es que tomes la que tú consideras que más se parece, la que tiene el plazo que más se parece, o la que ha sido emitida más recientemente, ¿no? Si voy a coger la de enero, no tiene mucho sentido si ya estamos en diciembre. Evidentemente hay ese efecto. Si no, si son idénticas y por esas cosas raras del destino, porque también hay temas de expectativas de los agentes económicos, ¿no? Evidentemente a la hora de tratar de comprar un bono, hay también lo que llama market sentiment, right? pese a que te digan que es triple A y pese a que haya todo esto, puede ser que por algún tema de carácter, si tú pienses que no va a pagarte, ¿no? Y por eso le cargas una tasa de interés más alta, evidentemente lo que tendrías que hacer es tratar de coger tal vez el promedio entre esas dos tasas, ¿sí? Y si el plazo son diferentes, como decíamos con la otra compañera, tratar de estimar una interpolación, ¿no? 5 años tengo tanto, 10 años obtengo tanto, si fuese el mismo plazo, y tratar de encontrar una interpolación claramente, en ese sentido. Sí, por ejemplo, ustedes saben que los portales tuvo muchos problemas hace unos años, en poder colocar sus bonos, ¿sí? En el mercado. Al notar que los portales recibía dinero y emitía bonos privados al 17% a las personas como parte de su forma de financiarse. Y era porque hace mucho más décadas el patriarca, el papá del dueño de los portales o la familia en realidad, dejó de pagarle al BCP y al Banco Vice. Fue un escándalo porque encima las empresas le fueron mal y no le pagó al BCP, al Banco de Crédito, y era parte encima del directorio del Banco de Crédito, un escándalo lo que pasó con la familia Rizopatrón en ese momento. Y luego ya los portales empezaron a emitir, y acá tenemos a los portales emitiendo instrumentos de corto plazo, con mayor tranquilidad en el mercado, ¿no? Ya después que han pasado 20 años después de esa mala experiencia que hubo hace décadas, ¿no? Coming back here, different alternative if you want to think about it. I think I mentioned that when we were talking about financing, right? Our friends at Superintendencia de Banco y Seguros, they have this thing called zero coupon curves, right? So logically here, I'm talking about trying to estimate it, right? But if you have access, for instance, to information from Moody's or from Proveedor Integral de Precios, right? They do have these curves, right? Let me just show you one curve and explain it very quickly. Vamos a hacer solo soberano. So you have this curve that I'm drawing, right? For different risk classifications, right? For AAA, AA, A, triple B, double B. If you have access to these companies that I mentioned, Proveedor Integral de Precios, which is a pricing company, Moody's, right? S&P, right? You actually have to pay for those curves. They actually are quite pricey, right? We're talking about $1,000, $2,000 a month for each one of the different risk classifications, right? We're talking about a significant number, right? But our friends at the Superintendencia de Banco y Seguros, what they are showing us is a curve related to the sovereign bonds, right? So they have depicted, based on the market information for each one of the different days, right? What is the sovereign curve, in this case in soles, right? Once again, this is a zero coupon, right? So it assumes that there are no intermediate payments, right, for everything. So imagine that it says that you are gonna get a loan, you want to get a loan that is only gonna pay, right, everything at the end, 5 years, right? So for 5 years, the sovereign is 221.1%, right? Okay, that's the interest rate that the government is actually paying for its bonds at that time. 21%, right, is the yield for the bonds for 5 years. So if you imagine that your company has a risk that is obviously higher than the risk of the Peruvian government, right? What normally practitioners do is add a premium on top of those 221 and figure out how much is going to be the interest rate or the yield that that company should be paying for its debt. How do you come up to that spread? How do you assume it's going to be 3%, it's going to be 2%, it's going to be 5%? That's the tricky part, right? This at least is going to give you a sensitive vision of how much you're going to be paying. You also have this in dollars, right? Here is the exterior dólar soberana, right? With different numbers for this time. And they actually perform with the different algorithms here, right? And you realize for 5 years significantly lower, 128.5 right now for the Peruvian government, given the current situation that we have, right? Of low interest rates in the whole economy, in the whole market, actually. Okay, so enough for required return on debt. I already touched base on that. I already mentioned the book values, right? You may want to go with this, honestly, try now to come up with comparables in our industry and our country, right? What's going on with other companies that are trading, right? And try to figure it out. Based on that, what's going to be the debt over equity? You actually, if you are working on your, well, you are probably already working in some of the evaluations for other courses, right? And investigación financiera maybe not right now, but we need to have access to Economatica, right, and Bloomberg to come up with what's going to be the debt over equity in some of our industries that we have already. And let me now go to a tax rate. You know that I wanted to highlight, try to use the marginal tax rate, right, the 29.5, right? We are forecasting this calculation. So let me focus on the last one that I haven't touched yet, right, which is the required return on equity, right? So required return on equity, the way we're going to try to calculate that, right, is going to be using the capital asset pricing model. So this is the basic capital asset pricing model that you have already seen before, right? Where we assume that you can estimate the required return on equity, right, considering the risk-free rate, and adding to that an element that incorporates the risk of the market, right? So this is like building cake, right, with several layers. So first you add the return for the risk-free rate, how much it should be paid for something that is risk-free, right? And then you add what is the risk of the business that I have, right? And in order to consider the risk of the business that I have, you already know that you should consider the expected return on the market portfolio minus the risk-free rate to have to what is called the market risk premium, right? So this difference is the market risk premium that we are going to consider in our estimation. The return on the market on top of the risk-free rate, right? And then you multiply by beta, right? And beta, as you know, is a measure of the sensitivity of the return on a particular stock. That's why the I that appears there, right? Compared to the market. Beta does incorporate the effect of diversification. You do know that, right? And it's basically the covariance, right, of the return of my stock compared to the return on the S&P divided by the variance of the S&P, right? So our friend here, beta, is going to be the covariance of the return on I, right, against the S&P 500, right? Let me just trouble putting this down. Now it appears it's working. That's awesome. So this is subindex, obviously, right? This is going to be subindex 2. And here we close that. Let's eliminate the subindex once again. We're gonna divided by the variance, right, of this element that I have over here, right? And that's basically what we're gonna try to estimate that. And logically, logically you can do that if you have enough information, right, about your company. So if your company is trading in the market, right, you're probably going to be capable of doing this estimation that I'm saying, right? Calculate the returns on the stock that I have, right? And calculate the return on the S&P, right? And calculate the covariance and divide by the variance, right? Or do this estimation using a regression analysis, right? You can do a regression, typical MCO, right? Regression, OLS regression that we are so familiar with, and come up with a calculation for beta, typical beta you're going to have, right? What this assumes, obviously, is that your stock, that you have a stock in the market, first of all, that the company is public, have a stock out there. And second of all, the return on your stock, right, it's actually a correct reflection of market values, right? And what I mean is that the price of your stock is a correct reflection of what is going on in the market. And unfortunately, right, for developing economies, trying to do this regression against the S&P, right, generates several problems. There are several biases and several frictions that prevent a correct estimation of the beta against the S&P, right? By the way, let me get back here, right? No, actually question that. I'm using the S&P as the market portfolio, right? I'm using the S&P as the market portfolio because the S&P is supposed to be an index that collects information from the 500 companies that are trading in the New York Exchange, right? The companies that trade the most, and these companies correctly reflect the exposure to different business, not only in the United States but also outside, right? So the S&P 500 is an index, as I'm saying, that will incorporate Coca-Cola, IBM, right, and the 500 more companies that you're going to see. And in that sense, you are going to be incorporating not only the effect of the risk of the business in the US, but also globally, right? And that's the whole idea of this market portfolio. You should be thinking about the whole market, right? And we are going to have companies that are involved, right, in real estate, that are involved in retail, that are involved in agriculture, right? And in that sense, you are correctly reflecting the market portfolio. Okay, let's get back to beta, as I'm saying. If your company is trading in a developed stock exchange, right? If you are trading in the US, if you are trading in Norway, right, as Copeinca, right, or if you are trading in the London Stock Exchange, right, as Pacamayo, imagine that. Well, the value that appears over there in the stock exchange will correctly help you calculate the regression analysis we are talking about, right? But what happens if your company is not in that situation, right? If your company do not trade in a developed economy, or even more than that, your company does not have any stock in the market, right? It's a private company, which is a significant number of big companies here in Peru, right? So if that is the case, what we'll try to do, right, is we'll adjust the capital asset pricing model. We're going to try to transform that capital asset pricing model, and we're going to try to figure it out how we're going to incorporate that, right, with the sovereign risk. Instead of going with my company, right, as appears here, we're going to go with comparables. I'm going to save this later on. Right? We're going to use comparable companies, right? Companies that are in the same industry. Let's put it here. We're going to be not calculating the regression. The regression is going to be performed by others, but this is going to be for comparable companies, right? For comparable in the same industry. And we're going to go even farther, right? In the same industry in the US. Because if we are talking about local economy, if we're talking about local stock exchange, as we have said, the prices do not correctly reflect the market values, right? So we're going to be using the US as our help here with the beta. Right? And we're going to see in a bit where to get that, right, from several sources in a minute. Okay, but what I just did is I just calculated this, right, for the US mark, right? This is the comparable for the US, and this should be the information of the risk-free rate plus additional data for the US market. If I want to consider this information for Peru, right, I need to add the sovereign risk. And we're going to add a country risk premium, right? We're going to touch base on how to come up with that later on, right? But you probably have heard that usually, right, what is added is it is the emerging market bond index spread, right? Well, that's the MB, right? So that country risk premium that I'm going to be mentioning here, right, is usually estimated with an spread. You want to calculate how much additional risk, right, should be rewarded with an interest rate, with a return, right, for that risk, and that's usually estimated with this MB plus, and obviously for us it's going to be Peru, right? G over here, right now. Peru. That's usually the way it's estimated, and we're going to see later on that that's called the tax adjustment as a way to try to come up with this estimation. What I want to focus right now in the following minutes, right, is to how do we come up with all these elements, right? And I want to highlight the fact that we are talking about here of information that is in US dollars, right, and for the USA. So this country risk premium, what it makes is transform that interest rate or that yield, that return that we get here, right, for the required return on equity for a US company, the required return that should be requested, right, to a Peruvian company in the same industry, right? And logically, some of you are already thinking about, okay, I can use comparable companies, right? And that's a good estimation. Probably you have seen this before when going with corporate finance one. And the reason that you are going to be trying to estimate these comparables, right, it's also going to have to do with how much leverage your company has, right? Remember, and there's several notes we have already posted on Blackboard. This beta is affected by the leverage, right? This beta measures the risk of the company. In this case, is the beta for comparable companies. And the problem that we have, obviously, is that we need to transform those comparable companies that have similar leverage to our company, right? Let me just show you where it is. Here. So I have already posted here that we are going to touch base on how to lever and lever betas, right? And how we're going to talk about asset and equity beta. I have also posted some chapters that are completely referenced, right? These are reference readings from McKinsey, Ryan, Rhodes, Westenfeld, and Jaffe and Berg that are related to the adjusted present value calculation and the equity beta levering betas at all, right? Okay, so let me get back here for a minute. So I want to go first. So where do you get the data, right? And you're probably already familiar with some of this information that we're going to be touching base on. One of the first sources, obviously, is as what Damodaran, right? Do have some information on its website that I wanted to highlight once more, right? question? No. So I already mentioned that there's a professor in NYU, which is called Swada Modaran, that has several information regarding corporate final evaluation at the Stern School of Business at NYU, right? One of the good things that he promotes is teaching and free information for everybody. And actually, you can get into its classes, right now more than ever virtually, right? And there are also YouTube videos that he has posted, and I actually have a channel which you can check it out. His classes regarding investments and corporate finance, right? Writing relates to his papers. There are working papers over there and some publications. Logically, he has not posted his book, but it's also available online. The thing that I wanted to touch base is data, right? Because one of the things that he helps practitioners, right, and other professors is he compiles data from the United States, right, and he actually calculates betas for several industries in the United States and other countries, right? He probably have some research assistant who help him calculate the different betas and the different information that is presented here. He actually updates this every January. The good thing that or the benefit that he gets, right, by uh, giving this information for free to everybody is that it has become the standard, right? His information, his calculation of betas, his calculation of risk-free rate has become a standard. And if somebody mentioned, generally, yes, I'm using the Modalans data, it's enough support, right, in order to not question that information at all. First of all, I wanted to get here, which is historical return on stock, bonds, and bills, right, in the United States, and we're going to open that in a second, right? And it's going to help us analyze what has been happening in the US, right, regarding returns on some particular instruments, right, some particular securities. So one of the things that the Modaran does, right, he actually has every information here, getting the data, right? He has this calculation of annual returns on investments in the S&P, right? Realize that we are considering the same number for or the same variable for the market portfolio. He does an estimation for the 3 months T-bill and the UST bond, right? The 10-year UST bond. He has that information here, and he has recently added this corporate bond estimation, right, as a way to calculate that. And one of the cool things that he presents, by the way, let me put here pixel, right, is what's happening if somebody has decided to invest $100 at the start of 1928. Right? Remember, by the way, that there was a depression in the United States that what actually was called the Great Depression, right? But comparing numbers to the 2018 numbers was very modest, but at that time was critical, right? Remember that between 1930 and 1932, that was the first World War in Europe, right? The US was involved at all. And if you have invested $100 at the 1928, what obviously would have happened, you have lost half your money, right? By 1932. I mean, but what obviously had occurred, and that's why people continues to foster the idea that people should invest in the stock market, right? And that's also a possibility for us to invest abroad, is that if we go along the several decades, those $100, right, in 1928, imagine going that fast forward, almost 100 years, right, 93 years, right, to, no, it's 91 years, right, to 2019, right, those $100 would have converted in $500,000, right? And that's the magic of compounded interest, right, or compounded return over this investment, right? And that's one of the reasons people promote investing in the stock market, right, as a way to secure your wealth in the future, right? Okay. What we wanted to focus here, right, as I mentioned, is the UST bond, right? And the UST bond, he was actually calculating, let me just come back, the average return for the UST bond, right, was estimated, was the arithmetical one, right, at 435 at that point, right, when he was calculating that. But logically, this is the information that you have at the beginning and not the current data that we should be trying to aim for, right? That's historical data that we have. Let me highlight this over here. So if we want to get the risk-free rate, this obviously, as I mentioned, is the historical data for the 10-year T-bond, and we would like to have the actual data, what is the market data. I'm going to use Yahoo Finance, but you're going to get the same information that you have in Bloomberg, in Reuters, right? And even in the central bank, right? The central bank actually have that statistic. And, and this is the information for the 10-year Treasury bond, right? Which is called TNX in ticker number, right? And we're going to see that this has right now a yield of 0.7760, right? As part of the number that we're going to have, given the current low level of interest rates that we have into the market, right? As I was saying, the central bank, oh yeah, by the way, if somebody's interested, they have extended the deadline for the program for advanced finance, right? It's a very good program, actually. What I was wanted to highlight here is an statistic. There's a series, right? And they actually have the 10-year T-bond right here in international interest rates. So there are other ways where you can get it, and you don't only Bloomberg to get that, right? That's what I want to highlight here when we are talking about. I have daily interest rates, and we're gonna have las intereses internacionales. Here is the treasury bond for 10 years, right? And you actually have the information up until November 3rd, so 2 days ago, right? So there's going to be plenty of data. We can download that and come up with what's the data we need right now for our risk-free rate, right? So let me get back here. The risk-free rate that I'm trying to estimate, you probably have seen this in one of my classes or other classes, right? Is usually calculated as the 10-year US Treasury, right? And why do you want to use the 10-year US Treasury? Once again, you want to use the US risk, US rate, right? Because the risk of the US is significantly low, right? The US, the United States have never defaulted on its loan, right? Even other developed economies, Japan, Germany, France, at some point in history defaulted on their loan, right? After several wars, at some time they decided not to pay their debt, right? And that actually created economic turmoil at that time. But the US have never defaulted on its loan debt, if you want to think about it that way. And that's why we focus on the US return as a measure of risk-free element. And the second thing that I wanted to highlight is why am I using years, right? As I mentioned, 5 to 10 years, right? In order to correctly estimate what's gonna be the maturity of the project or the business that you are evaluating, right? So any change that you expect to incorporate into the project or any change that you plan to the business, you're acquiring that, it should have all its effect already incorporated and matured by the 10-year threshold, right? So the 10-year has become a value, right, that is normal variable that is normally used by practitioners as a as a uso y costumbre, trying to find out the words in English, as a normal way to refer to the risk-free rate, right? In some valuations, you are going to see that some people do opt to use the 30-year US Treasury, right? It's also available here on the Central Bank of Peru, right? And in those cases, it is most likely that they refer to projects that are infrastructure projects such as project finance, right? Such as highways that have concessions, or such as dams, right? Represas, right? Like we're talking about almost, for instance, all that irrigation project, or in some cases, mining project, mining operations. Why do they aim to 30-year US Treasury interest rate or yield that we are talking about? It is because mining operations usually depleted all their resources, right? They are going to deplete everything. They're going to extract all the minerals in 20, 25, 30 years. That's usually the lifespan that you will expect for those operations, right? So once again, for the risk-free rate, we're going to focus on the 10-year US Treasury. You do have historical data that it appears here in the Modara, but he actually picks a number at the end. We can obtain information, right, for this 10-year yield, right, on the Treasury from the Central Bank of Peru, and just download that in Excel. They actually give us the data without any trouble, right? 2 days ago, it was trading at 0.89%, but you can actually look at it up, as I'm saying, in ornaments such as Yahoo Funds. It was, I have it right here, but you can actually come up with the value, right, for that one without any trouble. And it actually trades a lot. And you obviously realize that this thing was actually on 1.77, right, a year ago, right, and right now it's in the lowest 0.77 as a whole. It actually evolves, right, rapidly in several instances, right. This is not necessarily the lowest number, right? This lifespan only goes to the 60s, right? But actually has been lower in other instances, but it evolves, right? It's part of the normal cycle of the economy, right? And you probably have studied in your economics classes that there are several cycles, right? Usually cycles that are 5-year cycles of growth and recession, and there are other cycles that go farther than that for 20, 30 years at all. Okay, with that in mind, I already touched base on the risk-free rate, right? Let's touch now based on the expected return on the market portfolio, right? And on the market risk premium, basically, right? Because we can actually calculate this individually and try to subtract this individually, right? But what most practitioners do is we try to estimate everything as a whole, the market risk premium that we are getting here. And that's where the Damodaran help us, right? With this Excel spreadsheet. Because his spreadsheet has this risk premium calculated between stocks and bonds, right? For each one of the different years since 1928. There are going to be some values that are significantly high, right? Like 43%, and significantly low, like negative 41%, right? And that occurs logically in periods or years with significant volatility, right? But in most cases, when you go along with the average of this, right? I'm going to use the arithmetic average of this that appears here. That number, so give me 1 second, it's shown here, the difference between the stocks and bonds, that number is usually 6.43. I'm using the information between 1928 and 2019. Why are we using information that has such a long span, right? Such a long period into the past? Why we should be considering 91 years, right, into the past? If that makes sense or not? And the whole point over here, right, is that yes, this annual risk premium, right, considers the difference between the S&P return and the US bond return, right? But we should take into account all the different economic cycles that have occurred. So by considering information from 1928, right, what we are basically doing is we are incorporating data, right, that relates to economic recessions, economic crisis, right, uh, wars that have occurred, not only the world wars, right, one and two, Vietnam War, what has happened over there, the crisis with the oil, right, that occurs in the 1980s, right, the dot-com bubble that burst in 2018, all the crises that occur in the real estate market, right, and actually with the CDO's problem, and everything, and also the problems that have occurred, also the good years, right? All the economic expansion that happened in the 90s, right, with the increase in productivity in the U.S., right, and similarly in the 40s and the 50s, right, with the return of people from the war that have actually had an impact because of the baby boomers, right? So this number is actually a reasonable number, a sensitive number, by the way, because normally in several papers that try to estimate the market risk premium, usually they arrive to a 6 to 7% market risk premium in general, right? So that's going to be the 6.35 for the US companies that we should consider here as the market risk premium, right, in our calculation. Okay. Any questions so far on what I have been saying? Some of these, some of you may already heard one on another class. And please tell me if I'm saying something that is against some professor. Highlighting that they are wrong. So let's get to beta, right? Let's get to beta. And once again, I'm saying that if your company is not trading in a developed economy, right, you are not going to be capable of getting a correct beta. So we should try to come up with beta from comparable companies in the same industry in the US, right? So what I wanted to mention that this is one of the main reasons why Damodaran is famous, is that he has this information available here, right, for US companies, right? For Europe, from Japan, and all everything like that. He has the data for US companies. I actually downloading this data, right? You can actually, and we are gonna figure that out, right? And the good thing about this element that he's using, right, that he has this information for every sector, right? Every possible sector. He gets this information from data sets that he gets from value line, right, or other suppliers of information, right? He actually, what was a decade ago, right? A decade ago, actually, he actually allowed you to get the micro details, right? Which companies work here in the advertising industry, which went these 47 companies with all the bid and everything like that. He actually got into trouble with one supplier, right? And he explained that he can no longer provide those details, right? He can provide aggregate numbers, right? But he actually have the data for explanations of each one of the elements as he's using. So first of all, he has this beta for the US, and this is the equity beta, by the way. The equity beta is the beta you can get from the regression analysis, right? That you observe in the market. This is the beta that considers what is the covariance of the return of my stock against the return on the market right, divided by the variance of the market, the return on the market, right? And for instance, if we want to think about, right, several of our companies here in Peru, right? I just talked about Agrícola, Ganadera San Jacinto, right? Let me just get to agriculture, right? If we want to go to agriculture, we can try to come up with, okay, what's gonna be the estimation, right? Farming and agriculture, right? What's gonna be the beta for that, right? And it's obviously you do remember that beta lower than 1, right? Means that it has a lower risk than the market, right? And it has obviously applied that when you go to farming, right? The level of risk is going to be lower than the market in general, right? Or if we want to talk about a different type of equipment, right? That's hotel and gambling, for instance, right? It's going to have a higher beta than the market in general. Right? But let's get to something more clear here, right? This is the beta for the equity, right? And as you know, the beta for the equity is affected by the leverage of the company, right? Remember Modigliani Miller 1, right? So let me get that back here. Use this as an estimation. Should be better just this one. 1 second. So the Modigliani Miller, right? Remember, told you that when we are going to be talking about betas, right? If you want to talk in a Miller 1, right? You do remember that, okay, it doesn't matter if there are no taxes, right? This is going to be the return for the company, right? The expected return for the company. You actually were capable of thinking about, okay, we can come up with the same idea as weighted average betas, right? We said, okay, we can calculate what's going for the assets of the company, right? And once again, I mean Modigliani and Miller 1, right? And Modigliani and Miller 1, it says that there are no taxes, right? And this thing is going to be beta, and this thing is also going to be beta, right? And once again, there's no taxes, right? So what we said when we were talking about Modigliani and Miller 1, right? And to apply is that, okay, the higher the leverage we're going to be getting, right? The higher the leverage we're going to be getting here, the higher is going to be the beta of equity, right? Because the beta of assets is not going to be changing, right? Remember Modigliani and Miller 1, we said that, okay, it doesn't matter how you finance the company, right? If we get a higher level of leverage, right? The beta of the equity should increase to compensate the beta of assets, right? That's what you learned before. And the application from here is taxes, right? And it's going to be the same. It's going to be the same idea. The higher the leverage, the higher the beta of equity, the risk the shareholders are facing, right? Because the higher the amount of debt the company has, right, compared to its total capital structure, what obviously going to happen is this higher probability that the company may go bankrupt, right? That you're not going to be capable to repay the debt holder. So the higher the risk the shareholders are facing, right? Remember, the shareholders get the money out of net income, right? And that's the debt holders. The shareholders are the ones who collect at the end, right? So having said that, right, our equity beta that appears here should be adjusted, right, somehow to arrive to the unlevered beta number, right? And you probably have heard of the Hamada's formula to adjust this equity beta to what is called a beta without leverage, right? An unlevered beta is a beta for the company, but assuming that it does not have any debt. And we're going to go through the numbers in a bit, right? But the Modaran does present you that information. But the good thing about that is that you can pick up the unlevered beta here and re-lever it, apply the capital structure of your company, the effective tax rate of your company, and arrive to the beta of equity or the equity beta for your company, right? In the same industry. And here they have these formulas to transform this from the equity beta to the asset beta. One word of advice here, and several people make that mistake. Here, Damodaran has put an estimation, right? Where you can decide which is the tax rate that you should use in the Hamada's formula, right? Hamada's formula, by the way, is the equity beta, right, divided by 1 plus 1 minus the tax rate times debt over equity, this ratio of leverage. We're going to go into that if you have never seen that. What I wanted to highlight is that as long as this thing says marginal, right, you are not using the effective tax rate that appears here, which is the actual tax rate that the companies have been applied to, right? And you are using this 25% that appears here. So if you want to come up with the correct unlevered betas, right, you should change this to effective. Realize that the numbers are tweaking a little bit, right? They are no longer, the formula is no longer using this 25, right, for the calculation, right? So if it's effective, it's going to be using this tax rate, the E14 tax rate, not the F9, the E14, which is the value that I wanted, right? So this is a thing that sometimes people omit because they do not read the explanations and Q&A that he put over here in order how to come up with that calculation, right? Okay, so let's get onto the asset beta and equity beta side of the business, right? And this is on our Blackboard Learn, right? That I wanted to highlight. Maybe let me open the other one because it's, I think it's, I actually did a couple of more stuff notes on levered and unlevered beta. Oops, it's not working this. Okay, give me 1 minute. I have it right here. Okay. So this is better, I think. So let me confirm that you are looking at the same screen that I'm showing. Yes. This is also on Blackboard Collaborate. I don't know why it's not opening right now. I had some trouble with that page before. And let's imagine for a minute, right, that you want to come up with the beta of your company, right? And we need to consider the several betas at all. So let me start with the typical thing, enterprise value, right? I'm going to call that value L, reflecting the fact that that element, that variable, is taking into account that there's leverage in my company. So we're going to be, this is going to be debt plus equity, right? As I mentioned before. I'm going to assume that there is a company that does not have any leverage, right? So imagine a company that doesn't have any debt. If that is the case, remember, in that case, assets equal equity, right? And we are going to define that as value of the levered company, right? I'm also going to highlight the fact, right, that the company value, that the enterprise value that I have calculated, VL, can also be expressed as the value of the company without any debt, plus that additional benefit that I get, right, from having leverage. Remember, when you are incorporating leverage to a company, what you are getting is all the benefits that are coming from interest actions, right? Based on Modigliani and Miller 1, right? The value of the company is not going to change, right? Regardless how you finance that. The value of the company does arrive from debt if we consider taxes, we get the value. Right? So we are going to continue with this idea, and we said, okay, I'm going to calculate the enterprise value of my company, and it's going to be the value of a company that does not have any debt, plus the present value of this interest taxes that I'm getting from that additional debt that I'm going to put on top of my company that had not any debt before. Right? So we're going to come up with that value of the enterprise that we are analyzing. Let me rearrange terms, right? As transforming one to another side, and then we can replace one by another and say, okay, the value of the company without any debt should be equal to the value of the debt plus the value of the equity minus the present value of all those interest taxes. Right? We should be getting that in this calculation. Right? This is the equity value, assuming that you do not finance everything with equity, you finance a portion with debt. And in this case, we are subtracting that extra benefit that we get from the interest tax. So if we multiply these elements and we move this VU to the as a divisor, right, in each one of these variables, right, we're going to get an expression similar to this. The bit of the assets of the company, right, it's going to be equal to debt divided by the value of unlevered company times the bit of debt plus the equity divided by the value of unlevered company times the bit of equity minus the present value of interest tax shields divided by value of unlevered company times the bit of interest tax, right? It's very similar to what we had here, right? Modigliani and Miller 1. The only thing that's being added to Modigliani and Miller 1 to consider Modigliani and Miller 2, right, is the fact that there's going to be a beta for the interest taxes, right? Here is going to be a beta for the interest taxes to reflect that. And I'm putting this in a different context because I'm dividing by VU, the value of the level company, right? Obviously, this can be quickly expressed like this, can be used this way as it was before in general. I'm going to go with some assumption, right? And that's where we are going to arrive to the Hamada's formula that you probably have heard before, right? And the first assumption is, okay, remember the bit of interest taxes that we have said? By the way, the bit of interest taxes is the risk of interest taxes, right? And it's obviously related to the return or high return for the interest taxes that we have mentioned before, right? This risk of the interest taxes, it can be assumed that is similar to the risk of the debt, right? What does this tell us, right? Remember, the interest taxes are cash flows that we are not going to pay in to the government, right, to the tax authority. We are capable of getting those interest taxes, right, if we are capable of repaying the debt, repaying those interest expenses, right, paying taxes, right? And that normally happens with companies that has a low to moderate level of leverage, right? If the company is behaving properly, if there are no problems with paying that, we are going to be capable of assuming this, that the bit of interest taxes is equal to the bit of debt. If that is the case, I'm going to replace this into this formula, right? And we're going to get the beta of interest taxes repaid by the beta of debt here. If I rearrange terms, if I sum this and this, we'll come up with this equation. And if we replace the value of the levered company for the value of levered company minus the present value of interest taxes, we come up with this calculation, right? We're going to come up with this calculation. If we, on top of that, assume that the debt is constant in perpetuity, right? we are going to be capable of simplifying that present value of interest taxes, right? Remember, the interest taxes, right, that we have here are going to be divided by the required return on interest taxes. I have said that now the required return on interest taxes equal the required return on debt, because the beta of interest taxes equal the beta of debt. If that is the case, we can replace this here in the denominator, and the numerator is nothing more than the tax rates times the interest expense. Right? That's the interest tax rate that you are aiming for. And if that is the case, and then continue simplify, the interest expense transforms to the interest rate times the debt in each one of years, right? The interest rate is the required return on debt, and we arrived at the present value of interest tax similar to this expression. Tax rate times the required return on debt times the debt in each one of the years divided by the required debt. But if we assume that debt is constant in each one of the years, these things can simplify even further, right? And assume perpetuity, you can arrive at the present value of interest taxes in nothing more than tax times the debt that we have, right? So, assuming our prior equation that we had before, we can transform everything to this expression, right? That's a peer comes, right? What happens even further, for practitioners is we assume that this beta debt is usually very, very small. We assume that it's a very small number. So if we assume that this is 0, right, this whole term appears, and we can calculate the value of the beta of assets, the beta for the company with no debt at all, right, as this expression. I'm replacing value of leverage by D plus E, and rearranging terms, we arrive to what is called the Hamada's formula, right? And just you can actually go with the math here. This is a typical Hamada's formula. The beta of equity, the beta for a company with leverage, is going to be the beta of a company without leverage, multiplied times 1 plus 1 minus T times debt over equity, right? The leverage portion, right? And this is our typical Hamada's formula that you're going to see applied over and over by practitioners, and they usually assume the level of leverage is low. But implicitly, they are assuming everything that I have said, right? That the beta of debt approaches 0, that you are assuming that debt is constant in perpetuity, and the beta of interest taxes equal the beta of debt as part of that calculation. This formula that I'm presenting here, right, you probably have seen before, right, to unlevered betas, and it's the formula that Damodaran is presenting here when calculating the unlevered beta, the asset beta that we have, right? So once again, that beta reflects the risk of the business, right, for a company in this particular industry, and that company does not have any leverage, right, at all, no debt at all, right? So logically, we are going to observe, right, that some identical to what we had before, right? Some companies do have more risk than others, and logically have more higher unlevered beta as part of that estimation, right? For instance, if we want to go to engineering and construction, right, as we can say, it's Granny Montero, for instance, right, J. Cameti, you want to come up with a calculation of the cost of equity, right, required return on equity, or even further, the weighted average cost of capital, you are going to need to come up with, first of all, the unlevered beta. If we follow our formula, our idea, following this step-by-step calculation, and we are going to need to come up with this comparable, and we're going to use this unlevered beta, and we are going to relever that in a second, right? we're going to lever that with what is going to be the estimation of our uh, leverage for our company in general calculation. Let me quickly go over one to quickly explain that, right? So far, we want to go to the capm, right? I'm going to copy here the formula that we have just been discussing. Right? All I'm saying is we are going to be capable of getting this information from several sources, right? What's happening here? And what we're going to be doing is we're going to come up with a risk-free rate. As I said, we are going to be picking up that out of Yahoo Finance. I'm going to use this 0.7680, right? I'm going to come up with market risk premium. And obviously, as I mentioned, we're going to be using the Modaran for that. We can go with a sensitive number. I'm going to use the 6.35 that it has here. You can try to estimate that, right? And then we're going to go with the beta. Okay. But for the beta calculation, we are going to be assuming, right? Start with the levered beta or asset beta that we have over here. And I'm going to start with a company in the real estate development, right? I'm going to be using this company of 0.73, right? Like see construction that we have here in Peru. So 0.73, right? But you should try to aim in this situation right now is lever this, right? We are going to try to relever this, considering this beta. We're going to relever this this unlevered beta, and we're going to be relever this using tax rate and the leverage for this for our company, right? For our company in general. That's what we are going to be aiming to do in this calculation. Right? So let's assume for a minute that we are capable of identifying that for our company, right, it's going to be 29.5%, right, as part of the calculation that we have. We should start that. And we are going to be considering that the debt over equity, sorry, what's going on here? Sorry, that's this thing just started uploading. But the debt over equity, let's assume that is 0.5, right? That means that you are financing, right, with a lot more equity than debt in general in this calculation. Right? That's part of what you are going to be analyzing here. Can you hear me well? There's some noise over here. ¿Me escuchan, sí? The debt over equity is going to be 0.5, right? And logically, this implies that your debt over debt plus equity, right? Higher 0.5 divided by 0.5 plus 1, right? So you are financing 33.3% on equity, and logically, the other portion, well, sorry about that, the other portion that is being financing, right, it's the equity side, right? What we're going to be doing here, right, in order to relever this, right, is we're going to be applying Hamada's formula, with all the assumptions, right? I'm using all the assumptions we just discussed, right? And in order to do that, what we're going to do is we're going to calculate the levered beta for my company, right? Imagine that I'm going to know this information, and we're going to be applying the formula directly, right? 1 plus 1 minus tax rate times over equity. And that times the unlevered beta, right? What we are doing is we are applying this formula I mentioned, right? 1 plus 1 minus tax rate over equity times the beta of assets and levered beta. And that's telling me that my unlevered beta of 0.73 gets converted to a levered beta of 0.9873. Is that the beta for our company in Peru? No, right? This is the beta. Once again, I pick it up. Let me just get it back here. 0.73 real estate development, right? I pick this up, right, for real estate development companies in the United States. Right? This has no leverage. Okay. What we are doing is we are applying to those companies in the United States, right, the level of leverage that I have and the level of taxes that I'm facing. So this will be the levered beta for those real estate companies in the United States, assuming they have the level leverage of my company and facing the tax rate of my company. Right? That's what we are aiming for. Right? This is what we are going to calculate. Right? I don't. This is how we're going to be applying the formula in general. Does this apply all the time? That is this going to make sense? And the answer is no, right? Once again, when we talk about the Hamada's formula, right, we did mention that. Sorry, 1 minute. This. 1 second, please. Okay, it's time to go. Yeah. So what I was saying is, when we start this analysis, right, and we said that we can apply the Hamada's formula, right, we are going to be assuming that the beta of interest tax shields is equal to the beta of debt, right? Implicitly, what we are saying that is that the risk is low for our debt. Right? The risk of the leverage for our company is low to moderate, not something very complicated. And this is consistent with that, right? With a debt divided by debt plus equity, with a financing of my capital structure, similar to 33% to 1/3. Well, it means that I'm not facing significant challenges in getting the financing that is required, right? But this is only apply. This is capable only to apply if the level of leverage is low. This only applies in that situation. Let me put it there here with the Hamada formula, right? Not to moderate. But what happens if the level of leverage is high? If the level of leverage is high, we cannot use the Hamada's formula, right? Because the Hamada's formula assumes that the leverage is low to moderate, right? And where are we going to be facing that situation? It happens more frequent than you will imagine, right? Usually, you're going to be selling a company if you are working in investment banking. If you're working in yes, Sebastian, this debt level is low. You're working in investment banking or valuing a company to sell is usually because you the owner, the actual owners have run into trouble, right? They have probably increased significantly, right, the value of the debt compared to the total value of the company. They are no longer capable of repaying that, right? Um, a couple of examples of that. You do know about Immobiliary Group, right? Immobiliary Group was a real estate company here in Peru. But the debt level skyrocketed significantly, right? To the point that they actually have to go bankrupt, right? Because they were having these troubles with the banks, right? And all the people who have lent money to them. Applying the Hamada's formula to that company will have been wrong, right? If you were planning to sell Immobiliary, it was too high the level of debt. And in that case, right, what you probably would have need to do is transform everything, right, to a different formula, right, to relever the beta, right? And given the time, we're going to go into that next class, but it's here, it's in the notes. It's a second scenario, right? What happens if the risk of the interest actually is similar to the risk of the assets, right? It's a different assumption. So the level of risk is so high, right? It's more similar to the risk of the assets. When is that going to happen? It's going to happen when you have the interest actual is going to have a similar risk than the cash flows, right? The risk of the asset, the risk of the cash flows that you're going to be getting. Logically, it basically implies that if you're not going to be capable of getting those cash flows, you're going to be capable of getting those interest actions, right? And the formula on lever and relever betas is a little bit different, right? And we're going to go into that next class given the time. You can actually check it out over here. There's an additional explanation on that. Where is sorry, I cannot find the, here it is. There's additional information on that on the McKinsey readings that I'm posting, right? And explains the lever and unlevered beta somehow farther than I have done so, right? There's another paper that I use on my corporate finance class. I'm probably going to post it, but in order to analyze lever and unlevered beta, but it actually goes even farther, right? With several scenarios that practitioners normally do not use about that. So far we have talked about relevering is debt is low. We are going to talk next what happens if we relever when debt is high, right? Okay, ya, imagino that me imagino que va a tomar más tiempo para explicar la parte que sea deuda más alta. Seguimos acá por ahora y voy a grabar esto evidentemente en Blackboard y retomamos el día martes. Y si alguien se perdió el inicio de la clase, lo mismo que he dicho ahora voy a decirlo en la sesión del sábado y en la sesión del domingo. Y también está grabado, bueno, cierto. Sí, Sebastián.
Una consulta.
Todo un poco bajo.
Sorry, mis audífonos no son muy buenos. ¿Me iré a escuchar bien?
Ahora un poquito mejor.
Ya. Con respecto al beta, alguna vez escuché o me comentaron de que en caso una empresa esté expuesta a dos sectores directamente, dos, tres sectores directamente, y sus ingresos dependan únicamente de estos, muchas veces también se podría tomar el beta de estos sectores y ponderarlos o algo por el estilo, para utilizarlos para el cost of equity de tu empresa. ¿Eso cuán correcto es?
¿Me escuchas? ¿Me escuchas?
Ahora sí, ahora sí.
¿Estás escuchando, Motito? ¿Puedes hablar, Motito? A ver, ahora sí. Conseguí un par de parlantes para esta situación. Lo conté. A ver, ¿puedes repetir tu pregunta, por favor?
Claro, alguna vez escuché que comentaron de que en caso la empresa a la que uno está valorizando esté expuesta, o bueno, los individuos estén expuestos a uno, dos, tres sectores únicamente, o sea, yo como empresa industrial o lo que sea, estoy expuesto directamente a tres sectores. Ya el beta de mi compañía en caso no sea muy comparable a lo que tengo en el mercado, podría utilizar un promedio de los betas de estas tres industrias o el beta del principal. ¿Eso es cuán correcto es?
Ya, ok, ya te entendí. Déjame sacar el parlante porque si no se escucha mejor. Sí, el argumento que nos levanta Sebastián es, ¿qué sucede si yo tengo una empresa multisector? ¿Sí? Está en metals y mining, pero también hace machinery, right? Y algo de oil and gas, si quieres ver, tiene un modo, tiene tres sectores. ¿Ya? La primera idea que se tiene en mi mente es, si estás hablando de subsidiarias, ¿ya? Por ejemplo, la típica es en retail, ¿no? Que está en varios sectores. Está en el sector retail, pero tiene distintas cosas. Puedes tener el sector de ¿cómo se llama? Educación, ¿no? Pues no, retail ya no tiene educación porque la sacaron a... No, espérate, dame un segundo. Tiene el sector de cines, tiene el sector de restaurantes, tiene el sector de entretenimiento. Ok. O algo similar. Si están separadas en subsidiarias, ¿sí? Yo sugeriría valorizar cada subsidiaria independientemente, luego consolidar eliminando los intercompos, ¿sí? Que se eliminan automáticamente porque los ingresos son iguales a gastos, ¿sí? Y el flujo de caja te va a salir correcto sin ningún problema. Si no tiene subsidiarias, si la empresa está en tres sectores, porque está en tres sectores, ¿sí? Y el argumento sí es razonable de considerar un promedio ponderado, yo iría por un promedio ponderado, de los betas, ¿sí? De los asset betas, ponderando por la cantidad de activos que tienes en cada uno de los sectores. ¿Sí? A veces es un poco difícil hacer separación, evidentemente, pero yo sí me iría más por un promedio ponderado, no un promedio simple. ¿No? Por un promedio simple puede estar generando un sesgo, si es que la empresa, por ejemplo, entró en oil and gas un pedazo nada más, ¿no? O, por ejemplo, pues si tenemos una empresa que está, esta es uno de estos colegios cadena, pues tiene un área que es educación, colegio, tiene un área que es educación técnica, academias, tiene otra área que es impresiones, imprime libros, y tiene otra área que se dedica a las franquicias, ¿no? A la franquicia podría entrar de educación también. Esto va a tener una porción importante que es educación, ¿sí? Que va a ser básicamente beta education, sí que vas a calcularlo, y va a tener otra sección que es publicaciones, ¿sí? Publishing y otra más. Y en ese sentido, lo que vas a publish a newspaper, ¿no? Lo que vas a tener es que, oye, qué tan importante o qué tanto valor tiene entre los activos de la compañía, una y otra. ¿Sí? Y en el caso particular de esta empresa, el publishing no era tan importante, más el flujo de caja vienen por el lado de la educación. Si no puedes estimar el activo, si no puedes decirme cuánto es el valor del activo por educación y cuánto es el valor del activo por publishing, ve el flujo de caja. El flujo de caja, al final de cuentas, es el valor presente del flujo de caja, va a ser el valor del activo. Entonces, si más o menos hay un ratio, una relación entre el flujo de caja de uno y otro negocio, te va a permitir estimar adecuadamente cómo tienes que ponderar los betas que vamos a estar midiendo. Yo voy a ofrecer.
Ya, perfecto. Sí, está bien, eso es parte de la pregunta. Digamos, le doy un ejemplo para que sea un poquito más claro, tal vez. Yo tengo una empresa que hace
Estoy
packaging.
escuchando con reverberación. ¿Alguien más tiene problema de escucharlo? No soy solo yo. ¿Soy solo yo o pronto? A ver, un ratito.
A ver, ahora tal vez se escucha mejor.
Sebastián?
Sí,
Sí, a ver.
¿me escuchas mejor?
Sí, un poco mejor.
Ya, disculpe. Ya, en el caso de que, digamos, yo tengo una empresa que se dedica al packaging y esta empresa atiende, no sé, directamente es una B2B que atiende a dos sectores, digamos, educación y food and beverage. Yo estoy expuesto, yo como empresa de packaging estoy expuesto a esos dos sectores. Entonces, y digamos, en el beta de Moderán no siendo que las empresas comparables sean tan precisas, mi pregunta es, ¿cuán correcto es utilizar los betas de los dos sectores a los que yo estoy expuesto, ponderándolos por algún modo, como el beta para utilizar en mi cost effectiveness?
Eh, a ver, yo lo vería un poco más, y el argumento para mí sería lo siguiente. Claro, lo que está diciendo es, oye, yo estoy siendo en packaging y estoy teniendo dos sectores distintos. Estos sectores distintos eh, son los riesgos a los que estoy expuesto a través de este customer. El problema es el
Ok,
siguiente. El tema es el siguiente. Tu flujo de caja no solo son tus revenues, ¿sí? Vas a entrar por el lado de costos, vas a entrar por el lado de CAPEX, vas a entrar por el lado de en qué medida vas a estar expuesto a volatilidad de esos flujos de caja en el sector en el que estás, ¿sí? Educación tiene una volatilidad específica que no va solo seleccionada con cómo le va a ir bien al sector, sino qué elementos hay de riesgo adicionales a los que normalmente observamos de este sector. O sea, ¿de qué estoy hablando? Tú vas a estar pensando cuando te centras en el sector de educación, oye, acá hay un riesgo que entre un competidor, hay un riesgo regulatorio, hay un problema en el colegio, acá hay un problema que afecte los flujos de caja significativamente. Si bien eso evidentemente puede afectar a mí, que soy publishing o packaging, que le estoy sirviendo a ellos, ¿sí? También es cierto que a nosotros como packaging nos va a afectar otros riesgos. Otra posibilidad que entre un competidor, y hablemos acá de Porter, y podemos hablar las 5 Ps o todo tu diagrama de análisis de organización industrial, en qué medida este negocio se va a ver afectado con el servicio que yo estoy brindando acá. Y no solo es revenues, es el problema. ¿Sí? El problema no solo es revenues, es que también hay costos, mano de obra y demás, qué volatilidad hay, qué riesgo hay. Eso es lo que trata de recoger el beta, la volatilidad o incertidumbre de esos cash flows que voy a recibir. Y lógicamente, la volatilidad e incertidumbre de los cash flows que recibe la parte de educación, por ejemplo, es mucho mayor, porque acá hay un efecto evidentemente importante en el CAPEX que es requerido en el sector educación para poder brindar ese servicio específico. Sabido es, por ejemplo, que Innove Schools tuvo que construir su propio colegio, ¿sí? Porque la transformación de las casas es muy difícil. Comprar su terreno y construir sus propios colegios, con el significativo aumento de la deuda por el lado de ellos. La van a pagar y va a demorar y todo lo demás. Pero ese riesgo de la deuda, o mejor dicho, ese riesgo del negocio, ¿no? Porque es un riesgo del negocio que están invirtiendo en todo el CAPEX para poder desarrollarlo, porque este es el beta desapalancado, mejor dicho. Ese riesgo del negocio y que va a ser exitoso, no necesariamente se debe trasladar hacia el lado del packaging que estamos viendo, porque tiene otros riesgos adicionales. ¿Sí? Yo entiendo, claro, esta empresa solo se está enfocando en estos dos y por tanto, de algún modo, está solo expuesta. Sí, pero eso lo movemos en el flujo de caja. Ojo, ¿para qué estamos haciendo esto? Este beta que estamos hallando, lo estamos hallando para la tasa de descuento, para el WAC, ¿sí? Esa es la parte que está abajo, que está diversificada. Asume que estás en una empresa promedio, que no tienes tanto efecto negativo, idiosincrático de la empresa. Todos los riesgos en el beta están diversificados. No hay riesgo específico de la empresa. Se está asumiendo, evidentemente, que esta empresa, oye, le puede estar eh, sirviendo, atendiendo a una multiplicidad de clientes. Se elimina ese riesgo. Solo se queda el riesgo del apalancamiento. Entonces, cuando estás acá analizando este tema, resulta mucho más razonable modelar ese problema que me estás diciendo de, oye, tengo un solo cliente en el flujo de caja. y lo tiene que modelar a la hora de considerar el flujo de caja promedio. Tienes que decir, oye, ¿qué tan esperable es que en verdad me siga comprando esta empresa, este sector de educación, con los problemas que puede tener el sector de educación, ¿no? Que se le vayan los clientes, que hayamos que hay algún problema, que ocurre lo que ha ocurrido ahora, ¿no? Ya no te va, en este momento ya literalmente muchos colegios no están comprando materiales, los libros son virtuales, ese tipo de cosas se maneja más en la parte idiosincrática, en el flujo de caja, no en la tasa de descuento. En la tasa de descuento lo estamos manejando, diversificando todo el riesgo, ajustando eso sí por apalancamiento, para recoger correctamente el riesgo de ese elemento en el financiamiento. No sé si me dejé entender.
Sí, perfecto. Muchas gracias.
Listo. Ok, quedemos aquí. Señores, muchas gracias por quedarse tan tarde y por atender a esta clase. Nos vemos el día martes con ustedes. Gracias. Buen fin de semana para todos, sí, también. Si no los voy a ver.